In this video, we are going to explain how we have to close the entries for a merchandise companies using the different techniques.
Merchandise and commercial companies are companies that buy goods and then resell them without any transformation, such as bookshops, fashion retail shops, or groceries. There can be two types, wholesale or retail. In wholesale, products are obtained by a distributor and sold to a third party, usually in bulk. For example, clothing wholesalers who resell to retailers. In retail, products are bought from distributors and sold directly to consumers, for example, Zara or Pull&Bear. The main difference between these firms and service firms is the system of stocks, that is, the inventory housed in the first warehouse. Inventories are current assets tangible in nature that are or will become part of the product to be sold by an enterprise.
Point 1.1 Calculation of the COGS without inventories. COGS means the cost of the merchandise purchased, and in this section we are not going to take into account inventories. The best way to understand it is by an example. Company A buys some merchandise for 100,000 euros and sells all the merchandise purchased for 180,000 euros. This must be represented as the gross profit of 80,000. That is the result of the difference between the merchandise purchased and the merchandise sold.
So there is another option to calculate the cost of goods sold, as we can see in this example, that says Company B bought merchandise for 100,000 euros and decided to sell 80% of the merchandise at 180,000 euros 15 days later. And they ask us two questions. The first one that says how much is the COGS, and the second one, how much is the gross margin. So in the first one, we should know that the COGS formula is beginning inventory plus net purchases minus ending inventory. In this case, the beginning inventory is 0 euros and the net purchases is 100,000 euros. So we have to calculate the ending inventory by multiplying the 20% by 100,000 euros. That is equal to 20% euros. So the result of the COGS will be 0 plus 100,000 minus 20,000. That is equal to 80,000 euros. And the last question that says how much is the gross margin, that is the difference between the price that the merchandise was sold and the COGS, and the result will be 100,000.
Now we will explain the last option to calculate cost of goods sold with beginning and ending inventories. For this we will use an example. The first thing is to calculate how much is the cost of goods sold. Well, we know that we have a beginning inventory of 10,000 euros and we have made merchandise purchases of 100,000 euros. Regarding the ending inventory, it will be the remainder of what we have sold, that is the 20% of 110,000 euros. So, for the calculation, we add the beginning inventory to the net purchases and subtract the ending inventory, which would be 88,000 euros. Another way is to calculate the 80% of the sum of the beginning inventory and net purchases. The second question is how much is the gross margin? Well, it is the difference of the sales with the cost of goods sold, that could be 92,000 euros. All the transactions made by the company have to be registered as entries in the journal book. To do this, we have to take into account the following general aspects regarding the inventory accounts. The first one is merchandise inventory. It is an asset account and represents the value of the beginning and ending inventory. It is only used on those dates and not during the accounting period. Then the second account is changes in inventory of merchandise, which represents the value of the changes between the beginning and the ending inventory. With this account, we convert purchases into cost of goods sold. At the end of the period, we made an adjustment in the journal book with these two accounts as we see in the table below. So the changes in inventory of merchandise will have three possible balances. It will have a debit balance if the beginning inventory is higher than the ending one, so it will act as an expense. But if the ending is greater than the beginning, then it will have a credit balance and it will work as a revenue. Finally, there is also the option that both inventories are equal and the balance is 0.
Finally, we want to show you a complete example of a merchandise company. To do that, we choose the company books SA that present this initial balance, and we have those transactions that we have to add in the journal book. Here we have the work to do, and we are going to start. First, we need to calculate the COGS, and to do that, we need the beginning inventory, the purchases, and the ending inventory. To calculate the ending inventory, we have to choose a way to do it. In the presentation, it shows you the WACC and the FIFO, and we are going to choose the WACC value that, like you see, we are adding it into the COGS formula, and we have the final result that is 9,971.5 euros. The next point is to calculate the gross profit, and to do that, we have the sales revenue and we discount the cost of goods sold that we already calculated, and we have the final result. Then we are going to start recording the previous transactions that we see in the journal book and in the ledger book. First, we do the opening entry with accounts we already have in our initial balance. The next step is to start recording the transaction number 1 that says that the company purchased 6,000 units on account for 30,000 euros. Like you can see in the debit side, we put the purchases of merchandise, and on the credit side, the supplier's account. And in the same we do with the ledger book. In transaction number 2, books is A, sales merchandise for 20,000 euros. And it received the money half in cash and half in trade receivables, that we are going to put those accounts in the debit side and sales of merchandise in the credit side on the journal book. And we also record the accounts in the ledger book. The next step is to close in the inventories. First of all, we have to do the change in inventories that you already see in the unit before. So we are going to go to the next step directly. But you can observe the process in the video. Okay, to close the ledger book, first we have to close the temporary accounts. First the revenues, then the expenses, and then with those we calculate the net income and we start closing the permanent accounts. In the next page, you can see how we are going to close the journal book. It's the same process as the ledger book, but in this format. With the preparation of the income statement and the balance sheet of Books S.A., we are finishing the exercise. And here you can see that you need the income statement to calculate the net income that we are going to add in the equity part of the balance sheet of this company. An important data that show us that we are doing the things good is that the total assets and the total equity are the same. And well, with this final step we are finishing is to record again the accounts in the opening entry of the journal book of the next year. Thanks for your attention.